all 80s reform. Okay? India has the trade deficit worsening. So the current account deficit is being dragged down. Different problem. Same in the causes. So just before I tell you what the cause is, here is the capital flow. Another surge. I was telling you that 2006. See this? This is unusual. Normally you're getting this slow rise, and then suddenly you get one bump, and this huge bump in 2007, before the financial crisis. Massive. There's a problem. Either they are totally off. It's that same syndrome. They are looking at that straight line and thinking that the Indian economy is going to go through the roof. Okay? So everybody wants to come in and invest. Sometimes too much of a good thing is a bad thing. Okay? So this is the bad thing. Okay? And so of course the crisis hits and it collapses, but it recovers. Still bad. Okay? This is too high for the new growth rate. People are still thinking it's going to continue at 8, 9, 10%. That's the mistake. Now it's the same thing playing in reverse. Earlier they made the mistake for too long that the growth was lower than it was actually. In my view, the underlying growth rate is still 8 to 8.5%. Let's say 8 to be just careful. Okay? Here they are assuming that it's much higher. They keep bringing in more money. This is the problem. So what has happened? What happens is your inflation, the fiscal combination, and the capital flows, and the policy is not being followed. What I had warned in that paper, remember that capital inflow management paper, they are doing exactly the opposite of that. And that is the problem. That is the reason for the growth collapse. If they had done what was the lesson of the 91, it would not have happened. Obviously, you would not have got the huge bump up in 2010. It's incredible. I don't know why people couldn't think. In 2010, the growth rate was 10.5%. To me, that's a danger, not a thing to celebrate. How can it be when the whole world, we are talking about Greek exit, there could be a collapse of the financial system. I'm telling them that it will affect your capital market. There will be a huge surge outside. But what is happening is the QE 2 and 3. It's injecting money into the world. There are only 8 countries which are receiving it, emerging markets, and India is one of them. It's just that India looks less bad than everybody else. Nothing else is growing. The US is not growing, huge problems, political, etc. The economy is strong, it's a political problem. Europe, there's a constant fear that there will be a Greek problem. And we are telling, I'm there seeing this, you were telling about participating in that. So we participated in the Greek discussions and we pointed out things which they again ignored. And the interesting thing is this our perspective on capital flows. So they had not seen these things over there. Remember what I said? All things function smoothly. Capital markets are perfect, almost. Here we are used to dealing with these very funny things which happen if you don't have a good model, you get all kinds of odd things happening, you don't have complete data. Okay, so deflation. I used the private. I first introduced this into the economic survey many decades ago. So you see that the problem now is your balance of trade is declining, your inflation is shooting up, you're unable to control it. Different situation. Remember, inflation was going down over there. Okay, and then you have look at this long-term perspective before I tell you the short-term. Okay, let's look at the short-term. So what is happening is you're getting this the overall trend it should be depreciation. You're getting periods of appreciation there. Okay? And in the long-term perspective, it is interesting, just for future reference. See what happens. Yeah. This is the reform of the 80s, and what you do is you get a stabilization here. Okay? So what people think is the biggest reform in the history of the country is actually not leading to a big appreciation. Very odd thing, but I just want to leave you with that thought. So what is happening here is basically in the last 3 years, up till 2010, except for that danger signal, your real exchange rate is appreciating. That is lowering your competitiveness because of this huge inflation differential. I showed you the inflation. And therefore you are losing trade share, your exports are going down. So my argument was that since 2011-12 monetary policy is too tight, okay? And earlier it was too loose because it was too loose because they were thinking growth will be at 8-9%, so they were targeting that. Okay? If you reduce your estimate of the long-term growth, then it was too loose then, and it's too tight now. Fiscal policy, growth of consumption expenditure, huge growth. You heard of Narega, etc., but basically the consumption expenditures and subsidies are all going up. So what that does is, generally, government expenditures are more based, have a higher effect on non-tradables. Okay? Private expenditures affect tradables more. So non-tradables. Think of Narega, rural areas, rural consumption, generally non-tradables because agriculture is not free. It's controlled still. So it's not a tradable, it's an artificial non-tradable. And then urban land, it's another non-tradable. Okay? You can't import land from outside. Okay? It has no connection to prices globally. So land constraint, you're not creating, there's too much demand for urban land and prices are going up. So non-tradable prices, that appreciates the real exchange rate from the real side as against the RER which we estimate on the financial side. And then what you're doing is you're seeing this huge unprecedented current account which was not seen even in 91, 0.45%, never seen before. What you're doing is you're going on easing the capital shock. The opposite, exactly the opposite problem of what I said. Remember, just to repeat, when there's too much of capital, you've got to control it somehow. By putting taxes or something, you're doing the opposite. You're doing the wrong thing because your current account is already too high, you're letting that go even higher. So bad policy. Okay? And so the solution follows from that analysis is right now, we are in the current period, reduce consumption expenditure, government, subsidies transfer. What will that mean is it reduce your revenue deficit, which will raise your net savings of the government and therefore reduce the current account. Again, that external and internal balance. Loosen monetary policy because one of the problems is that corporate investment has collapsed. Okay? There's no consumer durable demand, there's no corporate investment. Okay? You've got to loosen the monetary policy and lower the interest rate and lower the differential. Remember, the differential when it's high, it attracts capital. And let the exchange rate float. Well, there was a little attempt where an attempt was made to keep it from depreciating. That fortunately is over. So this has kind of been implemented. And then you have to have structural reform to raise the corporate investment, agricultural reform, etc. So we stop all the time.
It's 11:22. I would really like to thank Dr. Virmani for such a scintillating presentation. It's the first time in literature I've seen somebody speak so clearly, so much of clarity, taking these 3 episodes into account. I've been reading his literature, his papers, and I'm really impressed. I wish he can document it, write it, and probably publish it in one of the international journals. I think such clarity, it will be useful for other policymakers. What I'm planning to do is, it's 11:23 now, and we have myself and Professor Vandana students are here. Let's have questions, 1 or 2 for next 7 minutes before Professor Vandana proposes vote of thanks. Any questions? I'm sure this lecture was challenging for all of you, and that's one of the purposes of good education. Your thoughts, your thinking is challenged.
There's somebody up there in the back.
So we'll take the first question at the end.
It's a very basic question. Currently, like in country, it's stagflation mode. We just want to understand why government always tackle inflation, not unemployment. What is the basic mechanism, dwelling around it?
What I would suggest, shortage of time, let's
collect question
and then you decide. Second question, yes, here.
So I have a question. So you touched upon the policy like Manrega and the problem the government has regarding the fiscal deficit. So how do you see the bills like a food bill and all, which is even going to increase the fiscal deficit? Is Indian economy ready for such bills? So what are your comments on this?
Good. Any other question? There was somebody this side raising their hand. Yes.
So what do you think would be the effect of the food bill on macroeconomic variables in India?
Okay. Any more questions, please? Or should we go with the first round? Anybody here? Okay. So, yeah.
So ideally, considering the Indian context, what should be the role of capital inflows? What is the desired effect? How do we want to actually, in an ideal world, what should be its role?
So we have 4 questions. Any more? Okay. Please go ahead.
In case of huge debts, what should be the fate of India? So as of now, we're seeing that the debt rate is increasing drastically. So what should be the policymakers' primary take on this one? So in considering the future, so what should they focus majorly to control this debt rate?
Yes.
Sorry, I didn't get that. They control what?
The debts, the rising debts of India. So basically, we're dependent more on the debt.
For debt, yeah. Right.
Okay.
So we have shown the growth rate in 2013, is there any projection for 2030, 2030 that you have done?
Okay. There was somebody here. Yes.
20 to
30, yeah. 30,
oh,
I think.
2030, future.
Yeah.
Yes.
Okay. Yeah.
So you mentioned of tightening the investments, the incoming investments, and loosening the outgoing investments to instill investor confidence. Given the current state of our economy, how much do you think we should loosen our monetary policy or continue on that?
That's a good question. You know, he's on the RBI Committee on Monetary Policy, where he goes there almost every 6 weeks. That's a very good question. One more. Let's take the last question. Somebody this side. Okay. So we have a couple of questions. So we have
One more. Let's just take that and finish.
Okay.
Sir, as you said that Indian trade reforms started from 1980, but similarly the China trade reform occurred in 1979. So why China is more successful in implementing policies than India?
Okay. So we have enough questions. So we have about 5 minutes. Students have another class to run to, and you have another class to start. So I would suggest be selective, and if we briefly can handle.
Yeah, we'll do it very briefly. So, problem is that in the US, in the West, they have periodic employment surveys. Ours are very poor. The good ones are like every 5 years. You can't manage macroeconomic policy using 5-year surveys. You're going to have it annual, quarterly, etc. So that is one of the fundamental problems. So we do address it when we plan. We plan for jobs, but there's no way to manage macroeconomics keeping jobs in mind because you don't have the data. So as it is, it's so difficult. So we use growth basically as an indicator of that. Let me do the one which related to this thing. So role of capital flows. As I told you, that thing we had put in place in the 90s, which was a 3-fold division, that the FDI is the best, so one has continuously argued for evening up. At this point in time, I would say virtually one could allow 100% FDI in everything. We already have, for example, people talk about defense. How can you allow in defense? Well, defense is simple. Defense, everything is controlled. You don't need to control FDI because there's a one buyer, the Ministry of Defense. It doesn't have to buy it. There are export controls in every country in the world, so they can't export. So they will do what you tell them. You don't have to say, oh, you can't have 50% or this percent. You decide. If it is in the interest of the country for the fellow to come and produce, they give him whatever is needed. I just don't understand the argument, for example, of controlling FDI and defense to 26%. It's ridiculous argument. So everything is controlled. I mean, it's defense. You know, he can't take a plane and give it to somebody else. Fight a plane. I mean, what's the problem? So, so this 3-fold division, FDI, equity. Now, equity can be destabilizing. You need to develop the market. That's what we've been doing. And the debt distinction we make is between short and long term. We still control very carefully the short-term debt inflows. So the question is to match this freedom on debt side with the development of the financial markets. And remember, the problem arises because developed country, the financial markets are very well developed compared to and efficient. Ours are fragmented, they are not developed. So the key issue is to develop the market and free up the system simultaneously. Okay, so it's merely a question of a path to a goal. We have no problem. They should be open and free and competitive, etc. But you've got to have the proper system, the regulatory system, the developed markets, etc. So it's really a question of doing that on the debt market. The rest has more or less been done. Monetary policy now, as I indicated, it's in the current situation where there are so many things going wrong and there are so few levels of flexibility. There has to be a joint measure on fiscal and monetary policy, and that joint thing effectively is tighten the fiscal deficit, loosen the monetary policy. Now one can understand if the government is unable to tighten in the way which I have suggested, then the RBI is constrained. So it's really a very, very tough bind, that you cannot really loosen very quickly if the fiscal remains tight. Because then you're confronted with this choice between growth and inflation, which, as I said, what my suggestion tries to break that you could get both lower inflation and higher growth, in my view, if you do what I am suggesting. Now, if you cannot do that, then I'm still biased towards looser monetary policy, because I think the effect on growth of tighter policy will be much worse than the effect of looser monetary policy on inflation. But that's a judgment you make, right? Can we afford less growth now? I think not. And that would imply that you tend to go with a looser monetary policy. On 2030 and China's success, that's a very interesting topic. Food bill is a little difficult because in the short term, actually, governments know how to manage. They can keep the thing below. But in the long term, given the huge inefficiency in the system, my argument has been that really what you should have focused on is improving the FCI and improving the PDS system before you even talk about this. Unfortunately, they always put the cart before the horse, and it's going to have the disastrous consequences you expect because of this weakness. It's not that you shouldn't give people money or not give money for food. That is not the issue in my view. So, when you're going to do that, firstly you have this terrible system where the wastage will continue. It will all be wasted. Secondly, you'll have to reduce some other subsidies. So you have to make a choice. Choice for what? It's not choice for getting food into people's market. It's getting the corruption in the FCI and the PDS. So it's a very bad choice. It's going to have bad consequences in my view. On monetary policy, we've done 2030. Well, I write a lot about that. You can see on my website. I have many forecasts, and most of my forecasts from 2004-5 onwards have been basically on track. The growth, what happens, but the key thing to understand, which again many people who just do it off the top of their mind when they are writing in the newspapers and all, is that there is something called catch-up growth. If you are a very poor country or a middle-income country, you really have a technology frontier out there, so you are basically adapting and adopting technology, so you can grow much faster, right? But we know again from history of growth that it slows down as you approach. It becomes more and more difficult to adopt and adapt technologies. When you are very poor, you have a huge choice, and you can select something which is useful for you. Select, I don't mean literally government deciding, but having a system which selects. So the growth will definitely slow down, and that brings me to the China point. The issue with China has been how is it able to maintain this? It's had an average 10% growth. It's unprecedented in the history of growth. Average 10% growth for 30 years. So the question is, why isn't this slowdown, which I'm just talking about, which is applied to every country in the world as you approach the frontier, not applied to China, but it has to apply at some point. The only thing is that many of us have been wrong in predicting that point. Okay? In 99, I put itself on record, which I was wrong. My current is again in those projections, which I'm on record. I'm saying somewhere in the middle of this decade, it's going to slow down. Okay? Interestingly enough, there's now a wide consensus against China watchers that in the next few years, 4 to 5 years, it's going to go to between 6 and 8. Some people are saying less than 6%. So it is going to slow down, is the consensus at this point. But it's very hazardous to predict the exact 8 or a year, because they are very good at short-term management. They are able to keep it up despite the fact it should actually be falling right now according to the consensus. But they are able to inject this money because they have enormous control over the economy. We don't have time to pursue that further. I think that's all the questions.
I often say this is the best time to take a course in macroeconomics because all the theories that you are learning are coming to life in the newspapers and the media. Thank you so much, Dr. Virmani. This is a rare treat and a very special treat to get a lecture from an insider and of his eminence. Thank you so much.